Hey, is super microcomputers going to 3x from here? In this video, I'm going to give you my opinion and my comparison of this particular stock to Dell and what Warren Buffett's personality says about this particular situation. But first, I want to show you this. This is the November 22nd Alpha report, and I think it's worth mentioning that I'm writing this now, and I'm writing that yesterday we thought NVIDIA was good enough and profit-taking might be limited, and the biggest beneficiary would be super microcomputer. Well, today, what do we look at looking back at yesterday? NVIDIA was up 53 basis points, the Qs were up 36, SMCI was up 15.12%. You could literally see my November 21 Alpha report, which you could get as well, where I literally say NVIDIA earnings should be good enough, and that super micro is potentially the play. Pull to that portion. Here we go. Still a steal under $30, and it is reiterated by my previous Alpha reports. So I just want to say, if you want to get this sort of information totally for free, I'm getting ready to send this one out 15 minutes before the market opens, and there's a lot more information in this. You get them totally for free. All you have to do is go over to meetkevin.com/alpha. So meetkevin.com/alpha. If you are in the United States, just go ahead and click this yellow button here, and I'll text and email it to you. If you're outside of the United States, click the gray button. That simple. Okay, let's now get into Dell versus super microcomputer. So super microcomputer's obviously been undergoing some fraud considerations, and we're going to touch on those. But what I'd like to do first is look at the valuation comparison. So what I did is I looked at the price to earnings ratio of Dell, 17.6 times versus Supermicro, 9.5 times. This suggests that on a price to earnings basis, Dell is selling for about 2x the valuation of Supermicro right now on just a price to earnings basis. Now, Dell is expected to have some more growth, and that's because for some reason in a few years, Wall Street thinks that Supermicro sales might slow and turn negative for 1 year before turning positive again. When I've seen this in the past, I've actually seen companies get around this by conducting layoffs or some form of efficiency protocols that end up keeping their earnings in growth mode, which could totally expand the average growth rate over the next 4 years for Supermicro. And the fraud allegations against Supermicro might actually accelerate that efficiency drive because now they've got a massive microscope on them. We'll touch on that in just a moment. But anyway, using current Wall Street projections for growth over the next 4 years, so I take EPS now and look at the average growth over the next 4 years, we get these values, Dell growing a little bit more, which suggests on a PEG ratio basis, you do have Supermicro trading for a discount on a price to earnings basis, earnings growth basis compared to Dell at a discount of about 25%. Okay, well, if I give them 25% on top of $35, it's only a $37 stock. Not much of a move, right? But that's comparing to Dell. And what's interesting about Dell is very diversified. When you look at Dell server and storage systems, 8% represents artificial intelligence, and only 6% of the entire company revenue in 2025 is expected to come from artificial intelligence. So it makes it much less concentrated play. The only thing Supermicrocomputers does is server racks and storage systems. Now, obviously, part of that is data storage, so not AI, but it is just a server and data storage company rather than Dell, which is also a personal compute company and so many other things that Dell does. Networking, you name it. Supermicrocomputer, therefore, might be a little bit more of a concentrated play on the next frontier for artificial intelligence expansion. That next frontier, I believe, is actually going to look like a water-cooled future. Consider this. When you pop in over here, you can see that air cooling will never go away. This is an article from 2023, so it's actually just over a year old. And they talk about there's no doubt that densities of server racks in reaching the point, or are reaching the point where some of them can no longer be cooled efficiently with air. Liquid cooling has a vast set of benefits, including increased efficiency, improved exclusion of dirt and dust, quieter operation, and delivers waste heat in a form where it can be used elsewhere. But still, air cooling vendors have a backlog of orders that have no signs of diminishing. Great. So a year ago, we're like, hey, we could still do air-cooled, we could still do water-cooled. But one of the problems that we're running into now is you have overheating concerns for the Blackwell transition for NVIDIA chips. And this overheating issue now, having the benefit of another year of insight, is being solved by the announcement by people like Michael Dell, the company Dell, and Supermicro, who's also in this space. What they're doing is they're announcing liquid-cooled racks, and they've been already doing liquid-cooled, but even better liquid-cooled racks to help support the latest and greatest NVIDIA chips. So to me, this suggests that water cooling might actually, rather than being that it'll never go away, might actually become the most prominent next phase of growth in artificial intelligence. So it won't necessarily be a way stronger LLM. It'll actually be not next level NVIDIA price targets, but rather, in order to support the growth of NVIDIA, and NVIDIA's growth just even if it's slower, NVIDIA's growth even just staying what it is, or even slowing but still delivering massive amounts from its pipeline, even if they had flat revenues year over year, it's still a massive amount of chips that they're delivering that need to be installed. You need to now install these in yet another revolution in AI. That is, the first revolution is, oh my gosh, GPUs do AI, great, everybody buys NVIDIA. Second revolution, we're doing the wrong racks. We've been using air cooling 90% of the time. Only about 10% of server racks right now are water cooled. Oh, we need all the new ones to be water cooled. Well, that could potentially be a game changer for growth trajectories for companies like Supermicro or Dell. So then I went a little deeper and I looked at the balance sheet of these companies. So from a debt coverage point of view, Dell only has about 47% of coverage for all of their debt. All right, what does that mean in English? Okay, well, just look at it here. I've got about $37 billion in total assets right here, but I'm going to remove these other current assets because I don't really know what those are. So I'm just going to call this $27 billion right here of cash, inventories, and accounts receivable at Dell. And then I'm going to minus out deferred revenue of $14 billion here. I don't really see that as a debt. And so that gives me over here, I've got, let's see here, 6.7 in short-term debt, 24 in accounts payable, 6.3 in accrueds. That gives me, what does that give me? 24, 6.3. That gives me about $37 billion right here. I wrote that down in current liabilities. Good, quick fact check. Then I've got long-term debt here of another 2.7 in non-current liabilities, 17.8 right here, long-term debt. I'm not going to consider deferred revenue, so I'm going to call it another $20 billion. So I've got $57 billion in debt, $27 billion in cash outside of deferreds and other current assets, right? That only gives me a 47% coverage of debts. Not great. Look at Supermicro. Now, it's possible all these numbers are a fraud, right? And this is back from March. So it's dated because we don't have the latest financials. So there are risks here, don't get me wrong. But at least from what we know then, which again could also be wrong, but at least from what we were told then, $2.1 billion in cash, accounts receivable 1.6. Okay, add that together, 2.1, 1.6. Inventories, 4.1, because I gave Dell their inventories as well. That's $7.8 billion. Okay, fine. What do we have in debts? Well, we're going to remove deferred revenues. And so we have current liabilities of about 1.5. And then if I go down here, I've got term loans of $85 million. I've got convertibles and other long terms. So I'm just going to take everything except for deferred. I'll call it 3.5. That's total liabilities. I don't want total. I just want to add this up over here. So I'm going to go 1.7 plus other, put in about another 0.15 for this other crap right here. That gives me debt of about $3.35 billion. All right, well, 7.8 divided by 3.35 equals 2.3x. So I could pay off my debt 2.3 times over. Consider that. Dell can only cover 47% of all their debt. SMCI can cover all of their debts, including their convertibles, which, I mean, those are just going to convert to stock at some point. This is why convertibles are such a great offering. It's why we're doing that at HouseHack, by the way. If you go to househack.com, we have an offering open right now. Read the PPM over there. This video is not a solicitation. But we have an offering where you could actually get all the upside in the stock as I try to build this company to prime for an IPO in the long term. And you get all the upside, but you also get downside protection in that you're a convertible bondholder in the meantime, and you're earning 5% interest paid out to you monthly. Kind of cool. Supermicro can cover all of their debts more than twice over, 2.3x over. So, in my opinion, even if I took, you know, $200 million for fraud, or even $1 billion for fraud, or even $2 billion for fraud charges, if there is even fraud, you know, it could just be a mistake, it's some auditing problems, or just like bad accounting and some oopsie doopsies. Well, what ends up happening, I still get to cover all my debts. You're still getting the company cheap, in my opinion. See, Warren Buffett, well, it's not Warren Buffett, it's, you know, securities analysis, so it's more Benjamin Graham. But they talk about how when companies undergo these accounting controversies, the stock price can actually create one of the greatest opportunities for buying because the valuation just becomes grossly low. And so that's where I look at this stock. I go, well, if they get to $5 of EPS in 2027, I give them a reasonable PE ratio or PEG ratio of 1.67 at a 10% growth rate, which I think is low going forward. I get an $83 fair value for this company. And see, the fraud allegations are going to put a microscope on their expenses. And when you have a microscope on your expenses, you're going to probably cut costs. And I don't think it's going to affect their backlog because companies who want to deploy Blackwell might not necessarily help NVIDIA's stock go higher because it's already so high and expectations are already so high, but could lead to more growth at companies like Dell and Supermicro than we're already anticipating. And the backlogs are so large. You know, the backlogs are roughly, Dell, they're probably about a year and a half out right now. You know, those are likely to keep growing, especially if you have to transition to water cool. So it's a whole revolution after a revolution already started. It's like, crap, we just built out all these air-cooled air-cooled systems. Now we have to rebuild again to water cool for the newest stuff. Sucks for Meta. Maybe that's why they're, you know, stuck down 10% off a peak. I mean, obviously the stock's done very well over time here, but still, it's kind of interesting to think about. So that's just my take. That's my opinion. So who knows? I could be wrong. None of this is personalized advice, but you know, I think this stock has a lot of upside, and I think most of the accounting stuff is overblown. Now, did I say originally that, hey, I wouldn't touch this with a 10-foot pole? Yeah, but I said that when the stock was trading for $48 to like $60 a share, and it was really before I went deep. I'm like, you know, my initial reaction is I wouldn't touch this company. That was when it was $48 to $60 a share. Then it got down to $18, and I'm like, bro, this has got to be getting close to book value. And I look, and it was like under 2 times book. I'm like, dude, this is trading for like, you know, a REIT, like a boring valuation. I think this is a cigar butt, you know. And then when you look at my 2x2 formula for valuations, pricing power is increasing due to water cooling, exceptional fundamentals, asterisk, fraud, valuation's very low, and the sentiment's terrible. This is like the best time to buy when you meet your 2x2 foundation. Always build a 2x2 when you play Rust. And get your alpha report over at meetkevin.com/alpha. It's totally free. Check it out. meetkevin.com/alpha. Thanks so much, folks. We'll see you soon. Bye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.